Good morning and welcome to this Wednesday, December 2nd, 2020 edition of Trading Places Live at Earnings Beats. I'm Tom Bowley, Chief Market Strategist here at earningsbeats.com, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, December is off and running. Today's December 2nd. Obviously, we had got one day under our belt in December. It was a pretty good day. Not everything participated to the upside. We saw some of the stay-at-home stocks certainly underperforming a bit. Not all of them, but some of them. And so I think this month is going to be kind of an interesting month, especially when we go through some of the earnings reports, because the earnings actually came in really strong last night. And I know that there are a lot of folks look at PE ratios and things and can't understand where, why the market's trading where it is and so forth. But when you take a look at how badly some of these companies are beating estimates, I mean, they're crushing estimates. I don't even think that the PE, the earnings estimates that are out there are getting swamped so badly. I don't even know why you want to try to pay attention to those earnings estimates. So I would continue to focus on the fact that these companies are beating. I think you got to focus on what the economy is going to look like after we get past the virus, which I think I think the market's already looking past it. I think we can see that in a lot of different areas that were impacted by the virus that are starting to bounce back and trade very strongly on a technical basis. I think that's giving us all the clues we need that the market is looking beyond the virus. But I think as we get, further into the first quarter, as we get into February and then into March, I believe that we're going to be looking well beyond the virus. And I think we have to look at the GDP. Personally, I think the GDP is going to be the strongest next year. If not next year, I think it'll be 2022. I think it's going to be the strongest of this century. And when you've got that combined with historically low interest rates, the valuations are going higher. I know you look back and you say, well, my gosh, some of these companies have come up so much. Many of them, though, are just getting back or getting close to the valuations before the pandemic hit. So they've got still room to run. And some of these companies that benefited from the pandemic, their earnings are still accelerating. Some of them, because of paradigm shifts, will benefit for years to come. And I'm thinking specifically about a company like Zoom. Because of the people that want to work from home. They enjoy working from home. A lot of companies realize the benefits of those working from home. And so anyhow, I think there's a lot still to look forward to. But we're going to have ups and downs. The market's going to always try to scare us out of our positions. That's what the market does. But I would say longer term, stay the course. If you're a short-term trader, it's going to be like any other market. I mean, you're going to get whipsawed from time to time. But longer term, if you're in it for the long term, I think you're going to really like what happens over the next few years. That's obviously just my opinion. All right, futures are weak this morning. We do have the Dow right now showing futures down 124 points, the S&P 500 down 11, NASDAQ down 52. So on a relative basis, they're all in that 0.3 to 0.4% down category. We'll see whether or not that holds throughout the day. We are in a fairly bullish period of the year. The first week of December tends to be pretty strong. We got off to a good start yesterday, and I would suspect that we're going to see that continue. Although, again, short-term movements back and forth, profit taking. We got options coming up in a couple weeks. There are going to be a number of things that are going to try to derail the market in the short term. But further out, I definitely see the market going higher. All right, let's go back. Well, let me share my screen here, and I'll take you over for those of you who are new to Earnings Beats. At our website, you can sign up for our free newsletter, Earnings Beats Digest, out every Monday, Wednesday, and Friday in the morning, usually before the market opens. No credit card required. You can unsubscribe at any time. It's really just to give back to the community. I mean, I think there's some decent trading candidates that we put out from time to time. A lot of what we do is educational, just trying to help folks manage. You see so many different things in the market. You read so many different things. We just try to block it all out and just look at the charts and look at the fundamentals. I do, my background being a former practicing CPA. Fundamentals are still somewhat near and dear to my heart, but I don't buy on those. I buy on technicals. And so it's really the combination of what we do at Earnings Beats. But that free newsletter will give you a really good insight into how we approach the market. Talk a lot about relative strength, some of the things that really, I think, make your portfolio tick. I mean, if you really want to do well, you've got to pay attention to relative strength. Here's our portfolio performance. Yesterday was not a good day. Even though the market went up, our portfolios did not. Some of those growth stocks that we had did not do particularly well. Model portfolio is still doing really well this quarter, but the other three came back. Actually, I think income portfolio did okay yesterday, but the aggressive and the strong AD portfolios both took a pretty good hit yesterday. So on a relative basis, they're kind of going along with the S&P 500 so far this quarter, but you also can see the since inception returns of each portfolio relative to the S&P 500, and I think those speak for themselves. All right, let's move on to the action on Tuesday. The Dow Jones Industrial Average up 185 points. The S&P 500 up 41. The NASDAQ up 156 points. Good relative action there. Mid caps up over 1%. Small caps up over 1%. So they continue doing very well also. Communication services led the charge yesterday. Nice bounce there. This is one of the groups that likes the month of December. So this is one of the only, I won't say it's the only one that does well in December, but in terms of significant outperformance, it's the only aggressive sector that tends to do really well during the month of December. Financials and industrials, actually, they both outperform in December, but just not by a whole lot. But they went in opposite directions. Yesterday, we had financials, first day of December, up 1.5%. Industrials, however, down 0.25%. So they went the other way. Industrials were the worst performing sector. In terms of industry groups, aluminum really coming to life at the beginning of November. Huge move up over the last 30 days or so. Renewable energy also has had another strong move, but that was not the case yesterday. It was down 4%. So it was the worst performing industry group yesterday, but that group probably deserves a little bit of profit taking and a pause. They've been on fire. 10-year Treasury yield. First of all, this morning we did have the ADP employment report out. So this is maybe a little bit of a preview of what we might see on Friday with non-farm payrolls. But the November ADP employment report rose 307,000, or they're created 307,000 jobs. Market was expecting 420,000 though. So it came up a little bit short. The October report was revised a little higher from 365,000 to 404,000. So a little bit of a mixed report there, but it is positive. Doesn't always tie to what we see on Friday with the non-farm payroll. So I think some maybe mistakenly look at it and say, oh, well, if the employment report from the ADP employment report came up short, that means non-farm payrolls come up short. And I've seen it completely flip. So I would not make that assumption. It is positive. Things are still recovering, which is good, but it clearly didn't come in quite as high as it was expected. 2 o'clock this afternoon, we'll get the beige book. And that's about it in terms of the economics today, or economic reports. 10-year Treasury yield, you can see up another half basis point today, 0.94% now, getting close to the high we saw in November. We were looking for a bounce off of this trend line, looking for a bounce off of this gap support off the 20-day, and we got it yesterday. So anytime that 10-year Treasury yield's rising, money's rotating out of Treasuries. That usually is good for the stock market. It was yesterday, and I think it will continue to be. Moving on, I want to go over some of these groups that have done well over the last month. We've seen a lot of rotation. When I look at the top 10 performers in terms of industry groups over the last month, only maybe 2 of them have been consistent. In other words, they were strong earlier in the year and they just continued being strong in November. One was automobiles and the other was non-ferrous metals, which is mostly Freeport-McMoRan, FCX. But those have continued to do well over the last month. But let's take a look at aluminum, for instance. Here's aluminum, which moved up, higher high, higher low, higher high, higher low, and now it's higher high. It's clearly trending higher, which is good. I don't like to chase, so this is a group with a huge move yesterday. I'd like to see it maybe on a 20-day test, but 20-day test will become very key, I think, in the days and weeks ahead. They're always key, But I believe the market is trending higher now. I think we broke out. I think the Dow went through 30,000, pulled back. I think we're going back through. I think we could have another pretty good couple of months here coming up on the Dow, the S&P, and NASDAQ, really across the board. I expect to see some pretty good action. Leadership, that's a little bit more iffy. Normally, I would say that NASDAQ's going to lead, but we had such leadership from the NASDAQ throughout 2020. I think it's still a little early to say whether or not the NASDAQ will lead. I think NASDAQ stocks will do well. I just don't know if they're going to do as well because some of these other, some of the weak stocks in the S&P 500 over the course of 2020 are starting to really accelerate. Same goes for the Dow. So they're playing some catch up. So I wouldn't be surprised if you said, hey, Tom, you got to pick the QQQ or the Spider over the next 3 years. You got to buy it today and hold it for 3 years. Which one are you going to pick? I'm going with the QQQ. But if you said, Tom, you got 3 months, which one are you going to pick? I don't know. I think Spider might outperform for the next 3 months. I don't mind owning stocks in both, to be honest. I think market goes higher. I think in the short term, it's a little bit more questionable. And I think we've seen that battle taking place between NASDAQ leading for a couple of days. And then all of a sudden the S&P and the Dow take off. The good news is everything looks good technically. And outside of maybe some stocks that are consolidating, I think the market looks really healthy here. All right. So anyway, there's your aluminum. Let's take a look at a couple other areas that haven't really talked about much over the last several months. Oil equipment and services. Now, the key here for me is, we don't have this long-term, and when I say long-term, I'm talking just the last several months, but we don't have a history here of a trend higher. We saw, coming off of just devastation, we saw a dead cat bounce, which is all I would label that. When you drop from 230 down to 70 in a month, it's hard to keep going down at that rate unless you're going to just go to zero in 2 months. So we got a little bit of a bounce, but the overall downtrend was still in play. The last 30 days or so, 4 or 5 weeks, you can see we've now been back in this uptrend. I would watch that rising 20-day really closely. I know that, we get questions from time to time, is now the time to go get into energy? Is now the time to go get into the financials? Well, we do have a history here going back into the early part of the pandemic. We have a history of this rally failing. I want to see a little bit more relative strength. I don't want to just react to 4 or 5 weeks worth of positive action. Yes, I think that's great. And I want wide participation in the market. But am I ready to just commit and say the next 3 months I want to be in oil equipment services? I don't know. I don't think I'm quite there yet. I don't think we're going back down to the lows. I think that low in March that was established there was the same as every other March low, or just about every other March low. I think those are lows that we probably are not going to see again in our lifetime. I said it back then. I said it in March that these are lows we're probably not going to see again in our lifetime. Everyone else, well, not everyone else, but a lot of folks were looking for Great Depression 2.0. I was not looking for that. I was looking for a rebound. I was looking for continuation of the secular bull market. We've gotten that, but there are areas that are still struggling on a relative basis long-term. And I would categorize oil equipment services and energy in general in that category. So yes, oil equipment services looks good. If I was looking at this group and I got a 20-day test, that's where I would be interested in getting in. If you don't have the patience for it and you get in early, just watch the 20-day. If it closes back below the 20-day, I would be careful. You can always get back in if it comes back up above the 20. What you don't want to do is start trending below the 20 and just hang on for dear life. That's what normally gets you in trouble. You can see August, we made the move back to the upside, and then look what happens. We were below that 20-day for the next 2 months, lost 30% in 2 months. You don't want to do that if this rolls back over again. So recognize it, admire it, maybe even embrace it if you want to get into some of these stocks, but be careful if they start to roll over again. They don't have long-term strength. I think if they consolidate, let's say it gets up to this 156 area and then consolidates for a period of time, maybe even goes back to the 50-day and then comes back up and breaks out, then we're starting to talk about 10, 11, 12-month highs on their chart. That's when I think things start to look much safer in terms of investing in these groups. I don't, my style is not trying to catch bottoms. I don't look back and say, wow, I really missed the move on energy. I believe the stock market's going up for the next 10 years. I just want to find relative strength, things I can count on and stick with those. I don't want to try to be a hero and catch every bottom in the market. I want to go really with what the momentum is, and not just the 3 or 4 week momentum, but the true momentum of the market. And when I say that, I mean, I could go in, let me show you this particular industry group on a longer term basis. And one of the things that I would be looking at. So if we go down to energy, OI. All right, so here's our relative strength over the last 3 years looking at a weekly chart. So here's the oil equipment services relative to the S&P 500. Does this chart look nearly as bullish as the one I just showed you, where it's trading above the 20-day moving average on that daily chart? This is what it looks like on a long-term weekly chart. Doesn't look a whole lot different than what we saw back here. The only big difference is we've moved up above the 20-week, that relative 20-week moving average. But we haven't gotten through the 50. We've still got our relative PPO at -5, which is pretty bad. So this, I don't want to get in just before the next leg down on a relative basis. This is a group that's been underperforming, not just the last 3 years. This group's been underperforming the S&P 500 for the last 9 years. Let me go back 10 years here. I mean, when you look at this chart, is there anything that really stands out? If you knew that over the next 10 years, the chart was going to look like this, is this a group you'd want to be in? Let's let it flip. I mean, if it truly starts to outperform, we can get it down the road. We don't need to jump in the first time it shows a little bit of strength. That's my opinion. That's the way I look at it. I would rather, you look at a group like software, which has really struggled, but I love the fundamentals for software. Some of the companies that reported last night, we'll get into earnings in just a minute, but some of the companies that reported last night came in with blowout numbers, beating top line, beating bottom line, raising guidance, and they're down. It's buy on rumor, sell on news. I mean, look at the difference. Would you rather be in software or would you rather be in energy? If you say energy, you're probably more of a value investor. You're probably looking at, hey, this has been a beaten down group, I want to jump in. If you say software, you're probably more of a momentum investor. You like the fact that it's been leading. Now we're consolidating. Well, we consolidated for a few months back in 2019, right before we exploded to the upside. Again, PPO here is above zero. It's been declining, not necessarily because the group has been doing horrible. It's been going along for the ride with the S&P, but it's not been powerfully leading the S&P. So the relative PPO has come down, but it's still above zero. Look at this. Back in 2019, it was coming down, but we just consolidated and then took off. Look back in 2018, it was coming down and we were still outperforming. Just because this line is heading down doesn't mean you don't want to be involved. If I'm looking big picture, I'm looking at this chart and saying, is this relative PPO line above zero or is it below zero? If it's above zero, I want to consider it. If it's below zero, I really don't. And so when I look at, filling out the portfolios with 10 leading stocks and 10 leading industry groups, this is one of the things I really focus on a lot. I want to make sure that we've had strength for a period of time and that it's not just 3 or 4 weeks and done. I mean, we've had a lot of those and we don't want to get caught in that. All right, let's keep moving. I want to show you scanning, because one of the actual chart that I used in I'm trying to think which one I used yesterday or this morning in the EB Digest, but I think it was a 20-day test. I put so many charts out, I can't remember them. But anyway, I think 20-day tests in a trending market is something that I would be running pretty often, if not every day. I mean, if you're a trader, a lot of times in a trending market, which I believe we're in, 20-day tests tend to set up pretty nicely. Does every 20-day EMA test hold? Of course not. I mean, I'm not looking for a guarantee. If you're looking for guarantees in trading or in the market in general, you're looking in the wrong place, because there aren't any. There are no guarantees in the market. The only guarantee in the market is that there are no guarantees. But this is a type of a scan that I would run. Now, I will tell you, if you're an Earnings Beats member and you copy this, you make a copy of it, and then you go and you try to run the exact scan, it's not going to work. And I get this email a lot. I get questions from members a lot. Why, when I run your scan, do I not get the same results? Well, first of all, this favorites list number, if you copy everything verbatim like this is referring to the list in my account at Stock Charts. It doesn't understand what the list is in your account. If you put this favorites list as 54, it doesn't understand in your account what that means. So don't do this. If you want to run this scan in your account, when you can copy this top part right here, that right there you can copy. The rest of this, what you want to do is after the close, this 20 EMA close or whatever down here, go down to chart list and go into your own account, find your chart lists, click on it. So here's strong earnings and add it. And there you will see strong earnings. Now I already got it in here, so I don't want it again. The other thing that I get a lot of questions about is, well, I've had, I've gone back and forth with some members and they're like, well, I'm not using your list. I am using my list, but I'm still not getting any results. A lot of times it's because these and clauses are in here. You can't look at all these chart lists and put the and clause in, because what the scan engine is doing is saying, okay, if a stock is in all 4 of these chart lists, then I'm going to return it. But if it's not in all 4, it doesn't get returned. Well, the strong earnings and strong future earnings they shouldn't, if they're done at the exact same time, they should never have the same stock in them. So by default, you're never going to get anything returned. So download these various chart lists. Make sure you go down and grab the chart list in your account, not in my account, because the scan engine isn't going to go into my account looking for favorite list number 54. Okay, hopefully that makes it clear. I get this question a lot, and I just want to, try to periodically talk about it to make sure everyone does it right. The other thing is when you do an or clause, so you're doing all of this, Scooter's got to be greater than 90, and the daily open has to be above the daily 20-day, the daily low has to be below the 20-day, and the daily close has to be greater than, all of those things have to happen. And when you start the or clauses, you have to have double brackets. See those 2 brackets right there? I had to add one because there was only one there. And when you get to the very end, you have to add another one. So you have 2. That is saying that everything within these 2 brackets are ors. That's what the key is there. Okay. So make sure you have that. And then when you run the scan, it should work. So I'm going to run the scan and just see where we stand. 5. So 5 stocks have Scooters greater than 90. They opened above their 20-day yesterday. They had a low below their 20-day, and then they closed above their 20-day. So what I'm looking for is stocks that opened above their 20-day, had a high obviously above their 20-day, went below their 20-day intraday, and then came back up. So it's almost like a false breakdown below the 20, and then it comes back up. And off of a downtrend, sometimes this can be a good strategy. And so you've got 5 stocks out of all of our chart lists that did this yesterday. So I'll just pull them up. Now, Home, I think, reported. Yeah, they reported. And they're down 5.5% in pre-market. But here's a stock that was going up, and it came back down, and it tested the 20-day. It's meeting the criteria. Now, does that mean I would have rushed in and bought it yesterday? Well, I should have checked earnings. So, no, I wouldn't, just because of earnings coming up. I wouldn't want to take that risk. Let's see. Let me do one more. IEA. So this is in the industrials. Industrials at the beginning of the show had the worst. They were the worst performing sector. So this is a stock that's got a 99.7 Scooter, obviously a pretty strong stock on a relative basis in heavy construction that tested its 20-day yesterday. So you go in and you look, it's been going up, came back down, tested that 20-day moving average. That's one that I might have bought. I didn't see it yesterday. I didn't run the scan at the appropriate time, but it came down, tested it, and bounced back off of it. Looks pretty good to me. Lumber liquidators. I wrote about this one because it had gone back down, hit that 20-day and bounced. I think this one was in the daily market report yesterday. So this one already talked about. Nautilus Group. Now this one is a little different because it meets the criteria, but it's not coming off of a downtrend. It's actually coming up from underneath. Maybe we're going to get a cup. I mean, if I traded this, I'd be careful if it went back down below the 20 because you don't want to get into a downtrending stock. And you can see volume's been pretty heavy on this move down. So I'd be a little careful. That alone, by the way, wouldn't take me out of the stock. This one was heavy volume, but we traded way off the low. Same with the second day. We traded way off the low. So it tells us there are some buyers coming in even with that heavy volume. So I'm not sure it didn't already set a bottom and starting to, move back up into a cup. But anyway, that's another one. And then last one, Penn National Gaming. Also getting up close to a recent high, pulled back, hitting that 20-day. This one looks pretty good to me, if I'm being honest. If it's truly trending, test off the 20-day, generally is going to be a pretty good entry point. So just wanted to point all of that out. Let's move on to earnings. Okay, so I was looking at the earnings reports, and there were a number of reports out yesterday after the closing bell. Every stock that I looked at that reported after the bell beat their earnings estimate. Every one of them. Every one of them beat their revenue estimate. Every one of them. And all but one of them were down after hours. And by the way, of all the ones I looked at, and there were 9 of them I think I looked at after hours. Of all the ones I looked at after hours, only one guided lower. 5 of them that I saw guided higher. Multiple guides higher. Next quarter revenues, next quarter earnings per share, the next fiscal year earnings or revenues. So many raised guidances. And then I looked at their reactions, and 8 of the 9 were down. And I think 5 of them were down 5% or more, including Salesforce.com, which was down 6% in pre-market last time I looked. So it's probably going to go back down and fill this gap, is my guess. And I'd be a buyer. I mean, I think if it gets down that far, I think stock looks pretty good. Salesforce is a solid company. They did announce an acquisition. They did announce that they are acquiring Slack, which is ticker symbol work, for approximately $27 billion. Most of that in cash. So $26.79 of their, it's roughly $43 a share, I believe, something like that. Don't quote me on that. It's right around $43 a share. $26.79 is cash. The rest of it, so for one share of work, you get $26.79 in cash plus 0.0776 shares of Salesforce CRM. So it's a combination of both cash and stock. So work will probably trade a little bit on its own. I noticed work was kind of flat in pre-market earlier when I looked, even though Salesforce was down. If it was an all stock deal, both of them would have been down. But work didn't get hit nearly as hard because 60% of that acquisition is cash. Salesforce.com. So look at the chart. Been trending higher. AD line for the most part, pretty strong. It's pulled back a little bit during the consolidation period, but we had these huge moves up. So I'm okay with that. I think overall, AD line looks good. Price action looks good. Relative strength, when it was moving higher all the way, and I don't remember if that was, I think that was combination earnings and then also announcement that it was going into the Dow. But if you take that move, you can see on a relative basis, well, here's software moving higher, but on a relative basis, CRM moved to a new high versus software. And while it's been consolidating, we're seeing relative weakness. But that's normal because the market goes higher. The market's been going higher. So it outperformed for a while, and then it consolidated. While it consolidates, it underperforms. So don't read too much into that. What I would be concerned about is, let's say it goes down and fails to hold on to gap support and continues to trend lower. That, combined with the relative strength deterioration, would bother me. But I don't think we're there yet. I think it's way too early to write off Salesforce. Let's take a look at another one, VEEV. Market getting ready to open here. This is Viva Systems, another one moving up. You can see AD line at the top, very strong. Relative strength, the software, very strong at the top, but we're consolidating. And while we're consolidating, we lose a little bit of relative strength. Viva came out, they posted 377 million in revenues versus 362 expected. They beat bottom line, 78 cents versus 68 cents. They guided quarter 4 revenues and earnings per share higher, and the stock was down 4% pre-market. I'm going to update and see where we are. Yeah, we're down 4.25%. That isn't a bad thing. It's just a lot of folks don't understand how the market works. It's, in this case, I think it's buy on rumor, and consolidate, sell on news. I think as these stocks pull back, they're going to represent solid buys. I think I would probably be watching this 260 area on Viva. I think if it gets down to around 260, that's been an area where this has been a strong buy. That would be more than $50 off of its recent high in October. That's a nice pullback on a stock that's growing earnings and raising guidance. But psychologically, emotionally, it's hard. If you're in this stock and you watch the stock go down $50, $60, bounce, and then come out with the earnings, good earnings, and it goes down again, you start getting frustrated. So what do? You sell. How do market makers build positions for their institutional clients? From people that get fed up and emotionally tired of sitting on a stock that's going nowhere while the stock market keeps going higher. So a lot of times these consolidation periods, while most traders get very frustrated, it's what allows market makers to build positions and get a good price for their institutional clients. That's what institutions look for. They want a market maker that can get them best price. And this is how market makers do it. It's frustrating, especially if you own a stock like this. But, and I'm not saying there's a guarantee Viva's going higher. Who knows? Maybe it breaks down and starts a long-term downtrend. But this is one way that market makers do accumulate shares for their institutional clients. Let's see, another one. Oh, let me give you one that was good. Network appliance. I think network appliance has turned the corner here. I've talked about this one recently. I mean, you see all that sideways consolidation. See how when it breaks out, it looks like a failed breakout, holds that 20-day EMA and then takes back off. This is one of the biggest changes I've made to my trading over the last 10 to 15 years. Is I used to buy breakouts, and when they would fail, I'd get out if they wouldn't hold that breakout level. And then I started seeing so many times, because I used to track my trades, and I would see so many times where stock would fail to hold a breakout, go down, test that rising 20-day, because the breakout gives us the first sign that it's trending higher. Holding the rising 20-day is the second sign. When it holds and then goes back to a new high, that normally is a pretty good signal that you're trending. You're no longer consolidating. And so look at what's been happening since. So now Network Appliance comes out with their earnings, revenues, $1.42 billion, market expecting $1.31 billion. Earnings per share, $1.05, market expecting 72 cents. And then they went on to guide their Q3 earnings per share higher. Now, Network Appliance, unlike all the other stocks that reported really good numbers, Network Appliance is being rewarded. Why? Well, I think it was because the stock, all this good news wasn't built in like it was into the other stocks. It wasn't a buy on rumor. I mean, we haven't been going anywhere. It's really just been the last few weeks that we've started to see any strength. So I think Network Appliance has turned the corner. We're starting to see relative strength versus the computer hardware group. And this is a stock, quite honestly, I think will do well going forward. Now, I don't know what the candle is going to look like today. We may be getting a gap up with a pullback. I think if we do pull back, gap support and that rising 20-day moving average become the two levels to watch for. All right, let's move on to the three you must see, and then we'll wrap up. I'm going to kind of continue this theme a little bit on these pullbacks. Fluor Systems here with the gap up, pulled back for 3 days, and you can see we broke out above this consolidation area, but we failed, came back down. Should we sell? Well, we held that rising 20-day, moved back up again yesterday. I'm going to give you an update so we can see what's going on today. But yeah, we're still above that 20-day. So this is a stock that I think is starting to look better technically to me. Now, AD line, not great. So if you're a big AD fan, which I am, if I have two stocks I'm looking at, one has a strong AD and the other has a weak AD, and everything else looks pretty much the same, then I'll go with the one that has the strong AD. So I'm not going to not trade it simply because of that, but it is a factor. I mean, I would rather have a strong AD or a strengthening AD. I mean, it looked pretty good here until we had these 3 really bad down days, including one very heavy volume day, and that's what really took it down. But it is holding that 20-day, so it's, to me, it's starting to look better. Defense stocks tend to do better as we get into the new year. Another thing to keep in mind, defense stocks really like January and February. So December, maybe not so much, but this could be folks maybe getting in a little bit ahead of time, looking down the road and looking for defense stocks to bounce. Next up, Discover Financial Services, DFS. Another one that's been trending higher, kind of struggled here at around the 65 level, finally got through, came back down, tested the 20 and off to the races. So it definitely looks to me like it's trending higher. Relative strength, very strong versus Consumer Finance Group, very strong versus the S&P 500. And then the last one I have is in the real estate area. This is AIV, Apartment Investment and Management Company. We're getting a gap up and a breakout today. Look at that double top. Came back down, hit that 20-day, bounced, and now we're getting a breakout. Real estate, this is the best group in the month of December. I sent out a seasonality report on Saturday to all of our members. Real estate, by far, is the best performing sector in the month of December. Let me show you the XLRE on a seasonality basis, and then we'll wrap this up. But you can see it averages going up 3.2% in the month of December. It goes up 70% of the last 20 years. And if we look at this relative to the S&P 500, it's outperformed 60% of the time, and it averages outperforming the S&P 500 by 2.6%, which, if you go along the bottom here, is the highest month of outperformance for real estate versus the benchmark. So this is a month that real estate tends to do well. So if you're looking at a stock like AIV and it comes down and tests at 20-day moving average as you go into the month of December, putting all of that together, and the AD line actually looks pretty good, even though you can see we were moving lower. Looks like the AD line was moving up. So I think maybe there was a little bit of accumulation that's been taking place during the weakness, and now we're starting to see the stock breaking out and moving higher. All right, let's see what the market is doing. I know we were down in pre-market. Yeah, we're still down. Got the NASDAQ down a little more than the others, down 100 points basically. S&P down 10, Dow down 140. We will see what happens as we move on. Normally the first week of December is bullish, and then we get into a period where you got to be a little careful moving toward the middle of the month. I think it's the 6th to the 15th is a little iffy, but especially around the 11th to the 15th. And usually in most calendar months, the 11th to the 15th is a strong period. December is the only month where 11th to the 15th tends to be pretty weak. And the whole month is kind of screwed up relative to the rest of the calendar months. Because once we get past the 15th, normally when you get past the 18th, 19th, that's when things start to get bad. But because of the holidays, I think it's more of a festive mood on Wall Street. And Wall Street tends to do pretty well in the second half of December. So I think, this week we tend to see a little bullishness. Then be careful after that. Around the 15th, 16th of the month, that's when we really start to see the market begin to pick back up again heading into the year end. So anyhow, that is it for me today. Everybody have a great day. I'll be back tomorrow over at Stock Charts for your next Trading Places Live. Have a great day, everybody. Happy trading.